Thank you very much, everybody. So we come last, so I know that the attention level might not be that high, but we'll do our best to kind of synthesize what you've already heard this morning, but bringing more a perspective in terms of what has been the evolution since 2015 when we talk about impact investing in West Africa, focusing mainly on Nigeria and Ghana. And the second aspect of the study that is commissioned by IIF and Ford Foundation is what can we do in terms of policy changes to really tap into the potential of impact investing. So we've done the study over the past 2 months, and we've been able to talk to most of the players in Ghana and Nigeria to get their perspective, but also do some international benchmarking, once again, to provide preliminary recommendation in terms of what could be done in our region to better tap into that potential. So I'll let my colleague Carl walk you through the findings, and then we'll try to have 5 to 10 minutes for some follow-up questions, and the two of us will be answering those. Thanks, Carl.
Thank you, Astou. And there we go. I suppose thank you to Astou, but also thanks to everyone in the room and a whole host of people we've engaged throughout this process, and at times, painstaking process of trying to demystify the sector and what's happened over the last kind of 4 or 5 years. So we've done a range of interviews, but we've also done a fairly extensive data gathering exercise to look at the transactions that have taken place and how capital flows have really changed and evolved. So we'll talk about that today. All of this builds on a study that was done back in 2015, looking at the overall West Africa region, and really looks to build on that and understand what's changed. Clearly in a context that's very different both for Ghana, for Nigeria, if we roll back compared to 2015. And I suppose a lot of this reflects some of the discussions we've had today, but the biggest thing we've seen over the last few years is a real increasing recognition of impact investing as a sector and people moving into the impact capital space. And I think it's probably fair to say an event like this would not have been the size it was 5 years ago. And with that, 2.5 times as many impact investors active in the market, an increasing bias towards in-country presence, recognizing a lot of what we've talked about today in terms of boots on the ground and a real proximity to companies, projects that we're investing into. And what we've seen with that is those who are already in the market have continued to grow. DFI players, non-DFIs are all doing more activity than they are before. And I suppose really kind of picking apart what that means, both that growth has both been true in Ghana and Nigeria, and those new players really entering the market. And what a lot of that, sorry, this clicker's a bit odd. What a lot of that shapes into as well is a real shift in how people are thinking about impact. It's been a way of really bringing more capital into the market. So whereas a few years ago we'd have looked at purely kind of quite often much more concessional capital, what we're now seeing is many more commercial players who are screening their deals for impact. So actually, commercial financing becomes a way of also delivering that wider social impact, and really kind of change the profile of the market a little bit more. And with that, what we've seen is kind of a huge volume of capital being deployed in the market compared to where we were before. So looking from 2015 to 2019 across the two countries, just shy of $6 billion being deployed. And I think what we really see in that space is a real continued dominance of the DFIs. And that's true both of the big international DFIs, but over the recent years, a real growth in domestic Nigerian DFIs particularly. I think something around just over $1 billion has been deployed by domestic Nigerian DFIs over the recent years. So a real shift in that pattern and environment. And I suppose when we look at how that landscape has changed and evolved, we clearly recognize a very different economic context around 2015, 2016 time. And I think what you've seen is that deployment has certainly been true, a huge peak in the volume of investing that's taken place. And all actors in the market have reacted in one way, shape, or form. So interestingly, you see that a lot of the DFIs actually continued to lend as the recession started to take shape, and then slowed down immediately after, almost as a longer lag time to really see that response. but also to an extent as well, some of that commitment to development impact and continuing that through a tougher climate. What you then see as well on the non-DFI space is a little bit more immediate reluctance, but it's not been a full-blown constraint. And actually that activity continues to lend. And what you'll see, 2019 data actually has been a reasonably good year so far, but what you're seeing there is basically the year is still going, and a lot of those deals are not yet closed and not yet publicized. So overall, that real strong growth. I think the other thing we've seen is a real emphasis on Nigeria over the last few years. When we did this study back in 2015, we were looking at two markets that were near equivalent parity, and Nigeria now being just shy of 4 times the size of Ghana in terms of impact investing capital. And what a lot of people are saying there is that, yes, both markets are viable markets to place capital. The biggest difference we see is the sheer size of the Nigerian economy actually compensates for what is an easier business environment in Ghana. So actually some of the fundamentals of the economy really shaping where people are choosing to lend and invest. And I suppose behind that growth, we kind of get into that question of how have people reacted over the last few years to what has been a very different economic context. And I think a couple of the panelists earlier said this, in that actually a lot of people almost turned around and said, what recession and what climate were we responding to? So the big thing you see is a lot of investors, once they've done their fundraising activity, have that continued commitment to the region. I think that stood out particularly more with impact investors as well, where the economic climate doesn't hugely change and at times only increases the importance of the challenges we're trying to address. And so a lot of it, when it came to the overall kind of economic growth rates, investors remain committed to continue. The Forex has always been a challenge and continues to be, but in many cases, impact investors are pricing this in when they're raising funds. This is a cost of doing this type of work, and both the investors and their funders have to and often are aware of those challenges. And I think the ease of doing business on the ground remained largely a similar situation. At times, even despite some of the efforts to really drive that agenda, people noted that, yes, it is still challenging, but also it's not a fundamental barrier to getting deals done. The fact that we're still seeing that huge level of growth in what is still a tricky place to operate does show that it's not always the biggest barrier. And I think kind of when you look at what people talked about around the challenges they see, a lot of this, and we won't spend too much time on this, really reflects a lot of the discussions we've had today. And what we'll therefore do is jump quite quickly to where do we go, what are some of the policy solutions and opportunities out there. But I suppose from a supply perspective, a lot of what we've talked about today, how do we get businesses more ready to take capital? The constraint is often not having the finance there, but finding enough good quality investments to put this money into. How do we really as well make it easier to find those, to get the data we need to assess them, and then really see the other challenges on the financial market side? How do we build greater kind of secondary markets that enable us to do exits? How do we also build greater fundraising success? How do we really show that both to international, but more importantly to domestic investors, that this is a space to actually put money into funds? And I suppose a lot of that as well sits in the context of a region that isn't as economically integrated as we all might hope, which at many times has constrained the size of the opportunity as well. You see that as well, kind of a lot of those get mirrored on the business side. When you speak to a lot of these businesses, the challenge of getting from being a small startup through to being ready to take the volumes of capital we're talking about here. Even those non-DFI investors averaging $2 million ticket sizes, it's not an easy journey to be able to accept that volume of capital. As we touched on earlier, you go from friends and family money to small loans to a big build-up before you're ready for this volume of capital a lot of the time. So how do we really both grow those businesses, get them the skills they need, and also address some of the challenges around how impact capital is perceived by a lot of businesses? A few years ago, a real big emphasis on and desire for debt financing over equity. Actually, the recession has changed that a bit, where some people out of necessity are increasingly turning to equity, but still work needed on that side to get that kind of demand environment to where we'd need it to be. And I think with that, the other thing we've seen is that ecosystem of incubators, accelerators, technical assistance providers that connects those two worlds. Connect those people looking to place capital with the businesses that are in operation and really help grow them. And I suppose the biggest thing we've seen is a real ballooning over the last few years in terms of the number of incubators in the market and brands we probably all know and have heard in the room. And at the other end of the scale, once these businesses are growing, once they take investment, nearly everyone has those technical assistance facilities to help businesses when they get there. What you see, much as there's a missing middle of financing, there's a missing middle of the type of support we need to really get businesses from a small, medium size to taking that volume of capital is much more complex. It becomes less around how do we get the minimal viable product off the ground, but actually how do we professionalize as a business? How do we build finance capabilities and things that neither end of the spectrum is really solving to get to that investment readiness? And so when you look at a lot of that context, that set the background for kind of a lot of what we looked at in terms of the policy challenges, both across the kind of bringing capital into the country, enabling that to be placed, and then ultimately really enabling the demand for that capital to be there. So we see that a number of challenges in those spaces around real recognition of impact capital as an asset class in its own right. How do we think about investor protections in this space? Real difficulties of raising local capital. I think when you look at the market overall, almost 90% of the market is DFI capital. And that number, when you actually then look at the non-DFI space, many of those other funds are still funded by DFI capital. So a huge fundraising challenge that needs to be met to really show that this is a space that we can bring non-DFI capital into overall. Big challenges on the blended finance space around, yes, these tools exist and these tools are being used in the market, but how do we actually increasingly bring the below market returns into the market to be able to blend it? All of the tools are there, but increasingly and consistently, the lack of that concessional capital that can really quite often pay for social impact and really make what could be a commercially viable component of a deal get off the ground in a way that means we get more capital overall. And again, on the other side, what we need to do on the support system side to really build those accelerators and think more around the system that sits around this as well. These policy responses are not just government, it requires regulators, it actually requires as well institutional investors thinking differently about the opportunity in the country. And we talk a lot about technical assistance to businesses and firms, but actually those other actors being equally in need of being supported and moved along the way.
So I'll just chime in here. Just chime in here in saying that, as Carl was mentioning, this is not preventing capital from coming. This is not preventing actors from doing business in Nigeria or in Ghana. But it is making it harder for them. So the idea for the study and for the benchmark and the rest of the slide that Carl is going to present is how can we unlock or remove some of these obstacles to increase and have a multiplier effect. So it's not to say that things will not continue to grow, but the pace at which they grow is constrained by these main challenges. And that's where we're going to get it.
And I think when you look at what that means for the opportunity, the fact we have seen a huge increase in the volume of capital in the market, even with these challenges in place, only speaks to what this could be with some of these challenges being addressed. And I think as we went through this, we really did reflect a lot on, there are things that you could very easily choose to address but aren't the binding constraint. And actually, where do we really put our focus? And I think kind of the first place we started was really, how do we get more capital into the market in the first place?
one of the big things that came up consistently was around recognition of impact capital, and a lot of investors saying this is an asset class that remains relatively undefined. And I think when we dug under that a bit more, there was a number of things that were driving that. So actually, one piece was around the ability to offer better investment protection as we go through that. The second piece was then really thinking about how do we market this as a product and an asset? That actually looking at it today in a consistent way with private equity and with venture capital misses a trick in many ways from a fundraising perspective. And thirdly, what you also end up doing is really not setting a standard on what you're hoping people to achieve. And a lot of the measurement challenges we talked about earlier, a real opportunity to regulate this in a way that says, okay, this is where we want impact investors to be. And that also enables a set of policy responses we'll talk about on the other side. Actually, if that's the bar that you're holding them to, you're also able to offer incentives on the other side. And I think you've kind of seen that incentivization in many other places. And I mean, one of the examples in the UK of real subsidies, tax incentives for those who are prepared to give that commitment to impact, and often fulfilling roles that the government needs to fill anyway. And therefore, the tax break becomes a natural and logical relationship for everyone. I think the second big theme we then looked at from a policy perspective was how do we really drive that fundraising through? And so thinking about building that local awareness, but local awareness alone not being enough. Really needing to support the kind of systems level change that's needed to get people investing. So, and when you look at it, there's a number of constraints on how much can pension funds allocate towards this asset class. And addressing those challenges is one real crucial part of the system. But even with those, you really need to build that awareness that these deals are viable and that this money can deliver the results, both that we want from an impact perspective, but also that those funders really want. And I think the wealth of examples we talked about in the room even today that say this is viable and it works, aren't always marketed fully to those investors. So really kind of connecting what often becomes an information gap and connecting some of those information failures becomes a real important piece in shifting that balance of what are DFIs doing, but also how are we bringing more capital into this market. And I suppose finally the thing we looked at was on the demand side. And a couple of big themes coming out here. So one really being the coordination and convening of that space around incubators, accelerators, etc. All of those quite often being funded through development partners who can bring in further concessional capital, but also how do they think about really this as a coherent ecosystem? Do we know what we're funding in the various places, and are we really kind of addressing and not leaving any gaps? So a big piece there. And the other thing that's come up has been the potential in certain sectors to really drive reform in particular sectors. So the example that's come up quite consistently has been off-grid energy has seen a huge shift over the last few years. And a lot of that has been enabled by the Rural Electrification Fund, the work that's been done there in partnership with the World Bank. And actually some of those regulatory reforms, a number of investors said, we have done deals we wouldn't have done 5 years ago. So actually the ability to pick sectors where we know there is that opportunity and address some of those bigger barriers. You see a lot of other places where investors say this should be a big opportunity, but the regulation makes it too hard to launch a product, too hard to get into the market. And with that, kind of a lot of opportunity there to really where we wanted to leave it in terms of the findings. And what we really want to do is kind of open it up for, gave you a very quick tour through the findings and through what we came out with. So I wanted to open it up to a few questions in the audience, and happy to do a bit of a discussion there. Any hands?